Welcome back to the deep dive. Today we are taking a massive stack of technical charts and really getting into the weeds of the BTC USDT market.
It's a complex world out there right now.
It really is. And this isn't just about reading headlines. This is about distilling pure, data-driven analysis for the week of December 1st through the 7th, 2025.
And the sources are technical.
Very technical.
Extremely. Full of jargon like moving averages, volume confirmations. But our mission right now is simple. We want to be your shortcut to pull out the critical price levels, the market psychology, and the key signals you absolutely need to understand for the next 7 days.
And, well, we have to start by just acknowledging the current environment. It's not exactly optimistic.
Not at all.
As we're looking at this data, Bitcoin is trading around $87,400. And it's just seen a pretty significant drop. It's already down about 3.8% over the last few days.
And the charts are all saying the same thing, right?
They're speaking in unison. The overall trend is a clear short-term decrease. No ambiguity there. Okay, so let's unpack that. What makes this particular correction feel, I don't know, different, or at least so highly validated, is that consistency you mentioned. We aren't seeing mixed signals.
Right.
The bearish trend is just. It's confirmed across every major time frame in the analysis, the weekly, the daily, and the 4-hour charts. So we need to trace the selling pressure back, start with the big picture, and find those structural integrity points, the support lines that have to hold. So let's start with that big canvas, the medium-term view, by decoding the weekly chart, the 1W.
The macro view.
Exactly. And when we look at that last completed weekly candle, I mean, the message is just... it's undeniable.
That's the big one.
It closed as a long, strong red body. To a technical analyst, that single candle is basically a declaration. Sellers are entirely structurally in control of the medium-term trend.
And what's fascinating here is that this control is, it's backed by commitment.
What do you mean by that?
Well, the trading volume during that major red candle was actually slightly elevated compared to the period before it. So this indicates that the selling is intentional. It's not just weak hands or some random noise washing out. It's active distribution from, significant players.
So if we're talking institutional sellers driving the price down on a weekly scale, they must have a target in mind, a crucial historical reference point. Where is the market aiming right now?
This brings us to the crucial anchor point for this entire medium-term correction. The price has already decisively broken below the MA25.
The 25-week moving average.
Exactly, which is a key measure of medium-term health. The current path points directly toward the MA99, the 99-week moving average. And this line is widely regarded by large-scale traders as the ultimate structural support during corrections.
So why the MA99 specifically? I mean, that's an incredibly long time horizon, isn't it?
It is, but institutional traders use these very long-term averages to gauge the true sort of cyclical health of the asset. When price approaches the MA99 during a bull run correction, it signifies a major reevaluation point.
A line in the sand.
A huge one. And our analysis pinpoints the MA99 support zone, specifically around $84,500. So the overall medium-term support zone you really need to watch is between $84,000 and $86,000. If the market keeps going like this, that zone has to act as the floor this week.
And given that we're starting at $87,400, I mean, that $84,000 target isn't far away at all. It sounds like the analysis is suggesting the pain is, well, it's far from over.
Absolutely. The weekly chart confirms the destination, and the daily chart. That shows us the velocity.
All right, let's zoom in. Let's feel the immediate heat with the short-term pressure points on the daily chart, the 1D view. And this is where it gets really interesting because the visual evidence of selling, it's just been relentless.
Relentless is the right word.
We're talking about, what, 5 to 6 consecutive red daily candles leading up to when this analysis was put together?
Yeah, and that streak confirms the strong selling pressure isn't just coming from one part of the market. It's coming from both futures and spot markets at the same time.
Meaning physical coins are actually moving. It's not just leveraged bets.
Exactly. And technically, the price was just.
Yeah.
It was instantly and forcefully rejected by resistance at both the MA7 and MA25 lines on the daily chart. That confirms that every little attempt by buyers to step in was immediately smacked right back down.
Now, I have to challenge the source material just a bit here. Sometimes, 5 or 6 red days can signal that sellers are getting exhausted. Why does the analysis suggest this isn't just running out of steam?
That's a great question, and the answer is all in the volume.
Okay.
Crucially, the volume increased sharply as the price fell. And when volume increases significantly on a move, up or down, It validates that move as being meaningful.
It gives it weight.
Precisely. High volume with a price decline confirms a true breakdown, not just a temporary shakeout or a liquidity grab designed to scare retail investors out. This is institutional selling pressure making the move stick.
So this is a real decline. As the market searches for a bottom this week, what are the specific points on the daily chart that you should be tracking?
The daily chart gives us 3 immediate, very precise support levels that the market is going to test. It's almost inevitable. First, you have $86,900, which is kind of the softest bounce point.
Okay.
Second, $85,800. And finally, that big one, the structural confluence point at $84,000, which lines up perfectly with our crucial weekly MA99 level. These are the technical floors that need to generate a serious buyer response.
So if the daily chart shows the relentless decline, the 4-hour chart, the 4H, that shows us the chaos and the speed of the recent pain.
Yes.
Our analysis talks about a specific sharp move, a major long squeeze.
That long squeeze was visible as just a massive sudden 4H red candle. And to give that context, a long squeeze happens when the price drops so fast that highly leveraged traders, the longs who bid on the price going up, they get automatically liquidated.
Their positions just get closed out.
The exchange, yeah.
Yeah.
Which means forced selling, which then accelerates the price drop even further. It's a cascading disaster for anyone with high leverage.
It sounds like the market just completely cleared the deck of any optimism. So what's the technical confirmation that this pain is now structurally, baked into the shorter time frame?
The confirmation is the crossover, the classic crossover of the shorter moving averages. The MA7 has now officially crossed down below the MA25 on that 4H chart.
And that's the textbook signal.
It's the classic textbook technical signal that confirms the short-term bearish momentum is fully engaged.
And for someone listening who is thinking about deploying capital or maybe even opening a long trade, what's the biggest warning the 4H chart is screaming at us right now?
It's the total lack of a clear buying signal. The analysis is explicit on this. It warns there are no clear signs of bottoming yet.
So don't try to be a hero.
Exactly. The price is still in free fall, or at least moving with extremely high volatility. You don't want to try to catch a knife when it's still falling this fast because you are going to get cut.
So what's the best case scenario then before recovery?
Best case is that the price first enters a period of sideways accumulation, consolidation. It needs to go sideways for a bit, allow the indicators to reset before any kind of meaningful recovery can even begin.
Okay, let's turn all this data into a forecast for the week ahead. Based on the overwhelming consistency here, bearish signals across the weekly, daily, and 4-hour charts, what's the highest probability scenario for this week, December 1st through the 7th?
The analysis assigns the highest probability, a 65% chance to Bitcoin continuing its drop, to test that critical structural support range of $84,000 to $86,000.
And that's based on everything we just discussed.
Yep, we have structural evidence from the weekly chart pointing there. It's confirmed by the increased selling volume and just the ongoing weak market psychology.
This raises a really important question, probably the most important threshold for you to watch. What happens if that critical MA99-driven support zone fails to hold?
That is the ultimate red line this week. The critical threshold you need to have on your screen is $84,000. If the price breaks down below $84,000, and this is the crucial part, holds there for a sustained period.
Like a full daily candle closes below it.
Exactly. If that happens, the analysis indicates the next potential target on the chart is significantly lower. That deep support zone is sitting around $80,800. That's where we see the next major cluster of historical buyer interest.
Wow. That would turn a correction into a much, much deeper dip. But what about the optimistic scenario? Is there any chance of a bounce or recovery this week?
Yes, of course. The secondary medium probability scenario is given a 30% chance. This would involve a bounce from one of the immediate support zones we identified.
From that $86,900 to $86,000 area.
Exactly. That zone has shown historical strength, and the 4H relative strength index is also getting close to oversold territory, which makes a technical bounce plausible.
But I'm guessing that bounce wouldn't exactly be easy.
Oh, far from it. If Bitcoin somehow manages to bounce successfully from $86,000, it's going to immediately run into a wall of strong short-term resistance right overhead.
Full of sellers.
Heavily populated by previous seller activity, yeah. That ceiling is identified between $89,500 and $90,000. To clear that level would require a massive injection of buying capital that we just are not seeing right now.
And finally, the outlier. The full, sustained reversal and a push to new highs.
That scenario, a strong increase past $92,000, is pretty much dismissed, only a 5% chance. The technical reality is Well, there are zero large-scale buy signals. The market is firmly in a corrective phase, and the constant high liquidation of long futures positions is just sucking all the potential upward momentum out of the market.
So the path of least resistance is down.
For now, yes.
Hmm.
And if we connect all this technical detail to the bigger picture, we really have to look at the market psychology. The price action across the entire crypto ecosystem right now is just, it's screaming a single unified signal.
You're talking about how all the major assets are moving together?
Exactly. The sharp simultaneous drops we've seen across major tokens, BTC, ETH, BNB, XRP, you name it, that's the definition of a classic risk-off signal.
And what does risk-off mean exactly?
It just means that participants, especially the large institutional ones, are actively moving capital away from risk assets. They're likely moving into more stable scores of value or even just cash equivalents.
So the market is collectively fearful and it's de-risking. How does that psychological state translate into these recent crashes we've seen?
It creates a vicious cycle. The recent BTC drop caused massive liquidations of those leveraged long positions, the long squeeze we talked about.
Right.
When those positions are forcibly closed, it adds more selling pressure, which accelerates the decline, which then fosters more fear. This increased fear pushes more spot holders to sell, and you get this deep psychological feedback loop. The current market sentiment is just. It's extremely cautious and defensive. No one wants to be the last one holding a falling asset.
So what does this all mean for you, the listener, who is maybe looking to enter the market or just manage your existing positions this week? The source material gives us some very clear, very actionable guidelines for navigating this high-risk environment.
The core advice really centers on patience and discipline. First, avoid the classic mistake of FOMO, fear of missing out as the market falls. Don't try to guess where the absolute bottom is.
A fool's errand.
Almost always.
Yeah.
Second, given that we see no clear bottoming signals on the 4H chart, you should limit opening new long positions until a floor is demonstrably visually established.
And for those who are focused on systematic accumulation, the dollar cost averaging or DCA strategy, that's appropriate during a correction, right? The analysis is pretty specific about the levels where strong buyer interest should pop up.
It's very specific. The suggested DCA entry levels are tied precisely to the support zones we covered. The recommendation is to layer in buys at, first, $86,000, that immediate support zone. Then at $84,000, which is that critical MA99 line in the sand. And if the market really does experience that deeper high-impact drop, the strong zone of $80,800, these are the prices where the technical charts indicate major buyer interest should reemerge and stabilize the market. So to summarize the week ahead, the overall trend is unequivocally bearish. It's driven by institutional selling and a widespread risk-off mentality. The market is aggressively trying to find a short-term bottom, and your key line in the sand, the metric that determines if we face a moderate correction or a really deep dip, is that $84,000 threshold.
And that leads us to our final provocative thought. The analysis gives us a clear roadmap for recovery signals. I mean, the specific chart actions you should be watching for to know definitively that the bear pressure has finally let up and a new entry might be safe. You need that external confirmation before you act.
Indeed. The analysis suggests watching for 3 key bottoming signals. First, you want to look for a pin bar.
Can you describe that?
It's a specific type of candle with a very small body and a long wick at the bottom. It visually indicates that sellers push the price very low, only for buyers to immediately step in and reject that price, forcing the close much higher.
That's a classic sign of buyer conviction coming in. What's the second sign?
Second, watch for a sudden large surge in buying volume. I mean, volume that just dwarfs the recent selling volume. This would signal a major player has just entered the market and entered aggressively.
Okay, so a pin bar, a volume spike, and the third.
And third, watch for the reversal of that 4H bearish confirmation we saw earlier. Specifically, you want to see the 4H MA7 cut back above the MA25. Keep a laser focus on those specific, undeniable signs for confirmation that the selling pressure has truly exhausted itself and the path is finally clear for recovery.